Good morning. Trying to wake people up. I know it's 11 o'clock. You're probably tired. I'm Cassandra Seier, Head of International Capital Markets for the New York Stock Exchange. The New York Stock Exchange is honored to be part of Capital Link's 15th Annual New York Maritime Forum for an always timely and important discussion of current conditions in the shipping industry. As we all know, shipping is crucial to our global economy. This is reflected in our capital markets, and in particular, the prominence of shipping companies on the New York Stock Exchange. Today, we have more than 30 companies from the marine transportation industry listed on our exchange. Shipping is a sector that often operates quietly in the background, but is vital to many supply chains, connecting nations, fueling economic growth, and fostering international trade relationships. Whether it's the transportation of raw materials, finished goods, or items in between, maritime transportation is a key component of international commerce. When the world's leading shipping companies choose to list on the New York Stock Exchange, they joined many of their peers within the maritime shipping space that are paving the way for innovation and growth. Fostering and expanding this international presence is a key focus for me and my team as we continue to welcome the world's greatest leaders and innovators to the New York Stock Exchange. Now you might think, why do maritime companies, among many others, list on the New York Stock Exchange? Our US capital markets represent the deepest pools of liquidity in the world with the highest level of regulation to serve the needs of investors and companies alike. At the New York Stock Exchange, the world's largest stock exchange, the quality of our markets and trading experience are paramount. This explains why we're the only global stock exchange with a trading model that combines cutting-edge technology with the guidance of experienced floor traders. The result of all this is a powerful community of icons and entrepreneurs that have listed on the New York Stock Exchange to both raise capital and change the world. These companies are able to leverage our community to network and share best practices in critical areas like good governance and sustainability, supported by tools and thought leadership events made available by the exchange. In my own role at the New York Stock Exchange, I'm responsible for attracting new listings from companies around the world, including in Asia, Canada, EMEA, and Latin America. This entails conversations with private companies and investors, including PE and VC firms, investment bankers, and other stakeholders on the IPO landscape on what the NYSE has to offer issuers looking to tap the public markets. As many of you know, the broader IPO market has been somewhat quiet over the past 2 years due to economic uncertainty and other factors. It may surprise you to learn that during this period, the NYSE has been busier than ever, speaking to C-suite leaders of our private and listed companies about key issues including market volatility, sustainability, and geopolitical and economic conditions. For the first half of 2023, NYSE set the pace for US IPO proceeds with an industry-leading $6.7 billion of IPO proceeds raised. And we were home to 8 of the 10 largest transactions. For the deals that got done this year in a very tough market, over 95% of them priced within or above the initial price range. And more than 80% traded above issue price on day one. These IPOs are a great positive sign that the market is looking for. We also welcomed 15 publicly traded companies that completed the transfer from another exchange to the NYSE, including Fiserv, which is a payment mobility company, and they were the second largest transfer in NYSE history at $72 billion market cap at the time of transfer. And more recently in September, we've seen 3 large tech IPOs, which are important indicators of investor sentiment and market appetite for new issuance. Profitability over growth potential continues to be an important theme for companies looking to tap the public markets in the current economic environment. As listing conditions continue to improve, the NYSE maintains a strong pipeline of companies planning to list at the exchange to join our community. Overall, NYSE-listed companies hail from 46 countries, generate over $20 trillion of revenue annually, and employ over 43 million people directly, and many more millions indirectly. Shipping plays an important role in this community. I'm certain it will continue to do so going forward. With that, I would like to thank Nicholas Bonozis, President of Capital Link, for gathering all of us here today for this important dialogue. And let us all continue to work together to support investment and prosperity in shipping. I'll turn over now to Keith Billotti, partner at Seward and Kissel, to kick off our next panel focused on capital markets, M&A, and consolidation. Thank you.
Cassandra, thank you very much for that. All of you are going to have to bear with me a little bit. I have a little laryngitis, but the show must go on. So I want to start out with our panel. Maybe we could just go down the row here. I know all of you are pretty well known to everybody in this room, but if you could just give a little introduction about yourself and your platform, and we could just go down the row. Christa, will you start us out?
Hi everyone, nice to see you today. My name is Christa Volpicelli. I am head our global maritime investment banking at Citi. I have been with Citi for over 20 years, and I have many colleagues as part of our shipping team who have been there longer than I have. So what we're particularly proud about as a team, we are a global bank with a presence across investment banking. So what I do is capital markets and M&A, as well as the corporate banking side. I'm based here in New York, but we have colleagues in London, Hong Kong, Greece, and many of the other hubs. Delighted to see everyone today.
Yeah, thank you. I'm Christa Eitzen, Managing Director at Clarksons Securities. We focus on the whole shipping space in Clarksons and Securities, mainly on the equity markets, debt capital markets, M&A, and advisory. We're leading in raising equity for shipping companies globally, and we're mainly located in Oslo, where I sit, and in New York, with local presence around the globe as well through our Clarkson shipping arm. With that, I leave it over to you.
All right. Morning. My name is Kwon. I'm a managing director at D&B Markets, and I've been with D&B since 2011. We, as you know, focus around the maritime, energy, and offshore space, and we are well represented with bankers both in New York, but also in Oslo, Singapore, and London.
Hi, I'm Mike Kirk with RMK. RMK was started in 2012, and we're an investment bank focused solely on the maritime space. I spend the majority of my focus on capital markets and M&A, but as a firm, we also do a lot of debt arrangement leasing and actual debt deployment through our alternative lender, Ascension Finance.
Nikos Petrakakos with Tufton. We're an investment manager focused in shipping. We have both public and private investment vehicles, and my focus is primarily on the decarbonization and energy transition side, investing and any investments in that space for us.
Thanks, everyone. You know, so the news cycle has been dominated by new economic and geopolitical realities. You know, and with this backdrop, maybe Christa, you could give us a little overview of the U.S. capital markets, you know, with this landscape in mind.
Sure, absolutely. I guess, you know, where we sit today, there's certainly a lot of uncertainty in the world. And, you know, when you look at the performance of the equity markets, it does become bifurcated depending on where you look. Overall equity markets are up year to date, but if you strip out some of the biggest tech companies, Apple, Google, Tesla, the overall market looks pretty flat actually, and you've got a handful of these large tech companies that are up 90% year to date. You look closer into the shipping segments and you see everything related to energy, tankers, LNG, LPG, with significant outperformance versus the overall market, and that's no surprise given the earnings in these sectors. And you see the supply chain related equities in terms of containers, liners, et cetera, down, but that is off of just a tremendous run that they had during COVID. When we talk to investors, you know, I would say it's a bit mixed right now. You have some investors who are feeling, you know, generally okay. There seems to be visibility as to when we're going to hit peak rates, you know, maybe one hike away. The expectation that the U.S., you know, perhaps will have a soft landing with growth maybe reaccelerating in 2024. But then we have a lot of looming things on the horizon, you know, most recently the horrible events in Israel and what's happening there and to the people. We have slowdown in commercial real estate, slowdown with the consumer. Mortgage rates today are 7 to 8% versus 3 to 4% a couple of years ago. And so as those things start to filter through, you know, there are questions that remain. All that said, you know, the markets are there, the markets are open. I know we'll talk about it a little bit later. Many shipping companies don't need to raise capital or have valuations where they don't want to raise capital, and that's fine. There's lots of capital sources available, public and private. And we have continued to see quite active issuance across the bond markets and the bank markets, which I'm sure we'll talk about as well.
Thank you. Christopher, maybe Clarksons based out of Norway, maybe you can give us a little bit of a European perspective.
Yeah, definitely, and I definitely agree with a lot of what was said from Christa. I mean, the markets today, there's a lot going on in the world, which is affecting everyone investing. But I think that's where we've been fortunate for shipping and sort of the energy sectors, which have performed very well this year and over the last couple of years in different segments. So I think that has been beneficial, that investors see that you can actually invest in shipping and earn money for a longer period of time. It's not just the small blips of a month here and a month there. It sort of started with containers a couple of years ago, and it's follow on with bulkers and tankers and LNG and various sectors that become investable. And I think there hasn't been that many primary equity transactions in shipping in general in the US nor Europe over the last couple of years. It's been a bit slower, and it's the same in 2023. But we do see a lot of activity in sort of block trade. Investors are rotating in and out of companies. And what we tend to see on the transaction that we've been working on is that the investor base has been primarily focused in Europe, being sort of 50, 60, 70% of the transaction covered from Europe, and a lesser extent from the American investors. And that, I guess, is a little bit of a reflection of how the stock markets or investors tend to look at shipping as well. It's typically a little bit more early phase in sort of the European end, and then Americans coming more online when it's more confirmed. But I think all in all, the capital markets are there, and there are definitely good transactions to be done for investors to sort of get exposure to the energy security and the shipping segments.
Now, Jay, DNB sort of straddles, both Norway here in the U.S. You have a presence, big presence in Europe and here. You know, do you have anything to add to that, or do you agree, disagree?
No, I think that's a good summary. I would say the big emphasis really has been energy security. That has absolutely been driving, I think, the momentum, and certainly what we've seen in the rate environment for most tanker, LPG, LNG names. And so I think right now I would say, Christa mentioned that there really isn't a lot of need for capital for most of these companies because, again, they benefited from a strong environment. We see companies right now trying to take advantage of probably more dual listings just to make sure that they're well positioned for when the market does hit another cycle. And so, you got companies like BW LPG looking for a dual listing. You've got companies like Himalaya doing a dual listing. So I think we're going to start to see a little bit more of that. Companies really just positioning themselves for really the next cycle. But it's a really interesting time period because there's there's a lot of the things are going right. And so the question is, what's that, variable, or what's going to happen in the next 12 to 18 months where we know there's always disruptions. And so to me, it's about energy security, and I think this whole energy transition and fuel question is really what's also driving the markets right now. And so, I think those who can figure out where that's going to where that will go and the timing of that, I think really has quite an advantage.
Now, Mike, maybe give us a little perspective from the private company side. These folks work a lot with public companies. Maybe you could give us a little perspective there.
Yeah, I think, on the private side, if you're talking about capital raising, I think it's sort of some of the same challenges or headwinds that you see in the public markets. But I think you also have most people that are probably sitting pretty good right now from a capital perspective. So it's people really looking to do things opportunistically. So I think bringing in capital on the equity side is the same challenge that it's been for quite some time. But the cash flows are there, which is really supporting credit. So we're seeing a lot more on the credit side. People able to go up on the LTVs, get a little bit more creative with structures. So I think that's more what we're seeing on the private side.
So, Christa, you alluded to the strength of the balance sheet that most shipping companies, obviously not all shipping companies are created equally, but generally speaking, shipping's in a pretty good spot right now. Folks may or may not be looking to access the capital markets, to fund their immediate needs. What are you, though, trying to pitch to your clients in the market? What's available to people right now?
So I think it's a question of what's available versus what are we pitching, and what are we pitching is going to depend on the circumstances of any particular company's balance sheet. Because I think, as Chris alluded to, the markets are there. You can issue equity. You can issue convertible bonds. Convertible bonds for some of the larger shipping companies are something that one could think about if you have the right size balance sheet, and that has been a market that's been there and active. And the bond markets are there. So I really think it's about kind of the balance of thinking through capital structure, maturity towers. You have seen companies opportunistically refinance things in the bank market at quite competitive spreads. And in the bond markets, one example, Maersk is one of the strongest balance sheets in shipping. A lot of liquidity, earning a lot of money. We helped lead the first green bond for Maersk back in September. Maersk has had a green framework in place for their bond issuance since 2021 with their euro issuance. This is the third bond that we have helped bring to the U.S. markets for Maersk. Started with $500 million, well oversubscribed and we priced at $750 million. And in the end, now Maersk is an investment grade company. It is linked to their green framework. So, as many people know, they have various initiatives happening in terms of dual fuel vessels, et cetera. But when you look at, what they were able to achieve, it was, a very tight spread, 165 basis points over treasuries. And that was a testament to, the strength of the company, the strength of their program, et cetera. And so I think companies, even companies with very strong balance sheets, are continuing to think about access to diverse sources of capital. And I know we're going to talk about sustainability a little bit later, but that's certainly playing a role.
Jay, what are you pitching? What's available? Is there a difference?
It's there's a lot available. I think that's just the reality. I think going back to the whole focus on energy security, to see, for example, Shelf Drilling, which is shallow water drilling company, $1.1 billion bond, right? So a couple years ago, we probably would never have seen that, but the ability to do a $1.1 billion bond tells you something, that there's clearly investor appetite, interest, and belief in the importance around energy security here. We're seeing transactions where we are working with private companies, looking at more infrastructure type funds who may be seeking opportunities in that space, and so we are seeing a bit of that as well. And then for many of our traditional shipping companies, the focus around energy transition, offshore wind is an important part of that as well. And so we are seeing companies spending time in that space, figuring out where they think they could play. Economics have to make sense, but for them, they are definitely looking in that space as well.
So I'd like to flip this around a little bit. What should shipping companies be considering as the main factors as they sort of evaluate, their capital raising needs right now? Christopher, how would you answer that?
Yeah, I think in general, shipping companies are doing quite a good job. For a period now, they've been earning and strengthening their balance sheets. and they're taking their time as well. They're not making irrational decisions and investments that will put them in a negative position into the market that we, as a house, think is going to be quite favorable for a lot of the different segments. And I think now we're in the position where we have a very solid investable framework for investors in most of the major shipping segments. And I think they're there. They're looking at it with a wanting and willingness to renew their fleets and make it greener and sort of follow the whole green transition, but also doing it with the mindfulness of making returns to investors. And I think that's been an important factor, and that's also how you're able to raise equity for these shipping companies. For example, Himalaya and 2020, sort of their whole focus is on, we're saying exactly what we're going to do. We're going to pay out the capital, and then we're going to focus on returning capital to shareholders. And I think as long as the investments make sense from a shipping company perspective, then there's capital there. But they need to make sure that it has returns for every stakeholder.
Now, Nico, you see this from a different perspective. Tufton, has a number of funds. You invest in private and public companies. As an investor, what factors should companies be looking at?
I would say that the way the approach is going is there's a bifurcation between different strategies right now, and we touched upon some of it with the energy transition. I think it's preventing ship owners from overextending themselves and doing speculative investments. I think the uncertainty has helped with that, while they've also strengthened their balance sheet over the last few years. And I think what's changing is the opportunity to invest in the secondhand market remains because of this prevention of speculative orders and things like that. Whereas on the other side, Jay mentioned this move towards infrastructure funds. Private equity got burnt several years ago. I think they're coming back to the industry in a slightly different way on the, when we're talking about private side of things, because the energy transition is shifting the industry to more of an infrastructure like core plus play, longer term contracts, more of a partnership rather than, asset play kind of investments. So, I would say investments in terms of ship owners, we need to remain cautious. We can't be going back to the speculative ways of that brought us to where we've been for the last decade.
Nico, I want to stay with you here. Tufton, back stainless tankers. You were able to do an IPO over in Norway. The IPO market here in the U.S. has been largely closed for shipping companies for a while now. I just know anecdotally we've worked on a whole number of them, got them through comments. There's no market for them here. Maybe you could talk a little bit about your transaction, why it was successful, why Norway, and tell us about that.
Yeah, I would say from the get-go, it was definitely more of a structure suitable for Norway. The approach of it was one, it was smaller size. Two, it was meant to be more of a yield co and more of a finite vehicle. We're not trying to create the next Odfjell or something. And the investor appetite in Norway was definitely a lot more in the path of what we were trying to do, and we saw that with the investors that came in. As sort of Christopher hinted, it was definitely more of that European approach. We didn't have much of the American engagement on that.
Go ahead, Chris.
Yeah, and to add to that, I think also an important part for that placement was that it was offering something different that was not already available in the market space. So okay, you had some very strong chemical exposure that we could get in sort of Odfjell and Stolt, but it was a different way, right? They're bigger, larger animals. So stainless was able to offer something to investors that was not already there. And I think that was one of the reasons why that the transaction was successful and able to be placed as well.
I think that's probably, to the point of why haven't we seen more IPOs? I think that's a great point. What investors do want to see is differentiation in any new IPO that's going to come to the market, any market, whether it's Oslo, New York, Singapore, et cetera. Investors will look at that company, understand the current capital structure, financial profile, power to generate earnings, and benchmark it against already listed alternatives. So it's not helpful when you have a sector that might be, you know, one of the commodity sectors trading below NAV. You have a new company that wants to come to that space, that can be very difficult. But if you have a company that is building something truly unique, whether it's operating platform, whether it's asset focus, whether it's technology, there was a panel earlier about earlier stage technology companies. Now, those companies aren't ready for the IPO markets today, but when you start to think about, you know, where we could be a decade from now, it's really the differentiation of a company's story that will help provide the backdrop for an IPO, not just kind of the sector dynamics.
You know, I want to shift gears here a little bit. You know, the other half of the panel is consolidation and M&A transactions. You know, obviously in the news, we've been seeing some pretty high-profile transactions, ones that were just announced. You know, what's driving this? What has changed in the environment? You know, I feel like, you know, we're receiving more inbounds. We're working on more M&A. Frankly, we're working on more M&A transactions than we are straight capital markets transactions right now. You know, maybe you could talk a little bit about what's happening in the market, what's driving this, and will it continue? And maybe we could, you know, Christa, if you want to start out.
It's interesting to pose the question as what has changed. We believe that these trends for consolidation have been here for a long time. We all know in shipping it can take longer in terms of some of the personalities involved. So I think what has changed, some of it is the passage of time in certain situations. What has also changed is just, you know, the valuations that we have seen in the public markets. You know, there's been some recent news lately in tankers. There's also been a lot of transactions of companies going private in the last 2 years in the contracted shipping spaces, whether it's some of the LNG companies, whether it's the privatization of the largest container ship lessor, which we advised on and closed earlier this year, whether it's some of the container leasing companies, the largest of which is now private. So what has changed there is there has been a huge amount of capital in the private markets with infrastructure funds who have looked at some of these sectors that do have an underpinning of contracted long-term cash flows, and they've seen an opportunity and have been willing to value those businesses better than they've seen in the public markets.
Mike, what are your thoughts on the recent wave of consolidation? Are we going to see more fleet acquisitions? Are we going to see more vessel acquisitions? How are folks approaching this?
Yeah, I think with M&A, you really have to have both sides. You have to have a willing buyer and a willing seller. And so I think some of the sort of, you know, situations we've seen where one side doesn't want to sell, you'll see things like poison pills, you'll see delays and disputes. The M&A that's happened in the public markets has historically been because there's been a lot of PE owners that have decided they want to get out. And so you see that. Otherwise, you know, without that, to my mind, it's much easier to do a fleet sale. You know, I think what we saw with Frontline and Euronav, you know, just made sense. It's a much easier transaction this way with the assets being sold. So I think we'll see that. I think, you know, you're seeing it in spaces like offshore where you have kind of a lot of unnatural owners. You know, whether those are distressed owners that got in a few years ago, some banks that own assets, you're seeing a lot more M&A in that area because you have people that want to sell.
Now, we're also seeing a lot of shareholder activism. We've seen companies buy into other companies. You know, is this going to lead to more consolidation? Do you think these guys are going to be successful, or is this really just a trade that's being put on? Christopher, any thoughts?
Yeah, I mean, I think a lot of times it makes sense for public companies to join teams and sort of make one larger company, which is even more investable and more liquid for the investors coming in. You're sort of increasing your exposure without ordering new vessels or without sort of making large acquisitions. You're merging together with already existing companies, and it's sometimes a benefit and sometimes a disadvantage that you have two trading stock prices as well, because you need to match up to make sure that both of them feel half miserable. If one feels like it's winning, then you're never going to get the transaction through. But I think, yes, there is room for listed companies to merge with listed companies. And there's also potential for companies that potentially want to do an IPO. If there are private investors that have a fleet of 10 to 20 vessels, but they're unable to do it because they're similar to what's already there, as we touched upon earlier. If you don't have anything new or special that you can add to sort of the the profile of the capital markets, then it's maybe difficult to raise equity for those companies. Then they can do ship-for-share transactions into existing players, as we saw when Trafigura made a ship-for-share transaction into Scorpio a couple of years back. And we're also working on several of those sort of typically transactions where you saw people getting exposure, and maybe they're not ready to, they still believe in the market that they're going into, and by doing a ship-for-share transaction or merger into a larger company, it's easier also to be flexible and exit when you want to as well, without having your name fully exposed on it. So I think, yeah, there's definitely room for more M&A in shipping in general.
So there's more room for M&A. Nikos, from your perspective, from an investor perspective, how do you view consolidation? Is it a good thing? Is it a bad thing? Do you not care?
I think in shipping, I'm sort of indifferent to some of it. I think when it comes to the traditional, bulkers, tankers, I don't see consolidation as a viable way forward. I think, once you have a decent mass of ships, anything beyond that doesn't really add any value. So I would agree with what Mike was saying. I think, in some markets, let's say that are a bit more operational, whether it's chemical tankers, containers, I think their consolidation can help because you're actually growing your sort of customer base, growing your fleet. I think their consolidation can help, but I think, let's say what happened with Euronav, I think what happened now versus what was initially anticipated with the M&A into Frontline, I think is definitely a better way forward. Eneti and Cadeler, I think that makes sense because it's a market where, again, consolidation gets you more power compared to your sort of counterparties. And looking at it on a private side as well, you look at the traditional private equities and their M&A approach, it's a build and add on. I don't see that happening with the traditional sort of shipping industry side of things.
Jay, I'll give you the last word on M&A. What are your thoughts?
Yeah, I would say, so our folks actually in Norway advise Frontline on the Euronav transaction, so we've been aware of that for quite a while now. But I would say that conditions are definitely ripe for M&A from the perspective that there is actually a fair bit of financing available, particularly for the larger names. And so, the Cadeler and Eneti deal is a good example as well. I think there is ample capital, particularly bank capital, I would say, for really the top tier names, and it is quite readily available to support large transactions. So I'd say, if you were asking earlier what are the conditions that's changed, I would say that's something that we have definitely seen, certainly over the last 3 to 6 months, that has changed. I think there is more willingness, again, not every name, but really top tier names to really step forward and provide the capital necessary to make some of these larger transactions work. And then I think you need the right conditions in terms of willing buyer, willing seller. As as Christopher mentioned, I think if you don't have that, it's just always much more challenging. It's not impossible, but it's just certainly much more challenging. And we see the transaction, for example, in the OSV space when Tidewater bought the PSVs, 37 PSVs from Solstad. That was a great transaction where you had a willing buyer, willing seller, and so you could go ahead and finance that trade, and each side was satisfied with the outcome. So I think those are kind of the conditions you need, but I certainly expect more consolidation, certainly in the coming months.
Energy transition's been a real big focus. You guys touched upon it earlier in the panel. How is, energy transition in the shipping space sort of impacting capital raising? I guess I want to give all of you a chance to answer this. What investable opportunities are there as we go through this energy transition process? Christa, maybe you want to start out.
Sure. It's a broad topic. It certainly is a topic that has shaped the debt markets in a definable way, whether that's through the bank markets with Poseidon principles, whether that's through the bond markets, which I talked about earlier in terms of companies that are putting in place green bond frameworks and then leveraging that as they market capital to really a deeper investor base. There's certainly when you talk about raising capital associated with energy transition, there's an increasing concern about greenwashing and so forth. But I do think that, as investors have gotten more sophisticated, they'll take a look at the whole company. They'll take a look at the whole company's approach. All investors will have different ways of measuring and monitoring. But, one thing that's very clear in this industry is, energy transition is important. It has to happen. Nobody knows the fuel of the future. So, companies are doing different things. And I think there is capital there to invest it. Also when there is an economic principle behind it as well. But it's shaping, it's shaping capital. It's also shaping M&A discussions as you think about, whether it's traditional companies that have traditional fleets and, where will this business be in 10 to 15 years? Do you have scrubbers or not? Or what kinds of investment decisions may I be making today opportunistically that, I don't know exactly how they're going to pan out, but, am I allocating a small piece of, my investment budget for some experiments, if you will?
Yeah, no, I definitely agree, and I think sort of the important factor is, yes, the companies are focusing a lot on ESG, but I think the important part is that there need to return cash to shareholders. I think that's sort of one of the main themes, as Christa mentioned as well. I think that's at least what we've seen sort of when you raised equity for Klaveness earlier in the year for green initiatives. I mean, it's important that there is a payback on it, right? So that people do it, but they do it also for a reason that they can get a return on it. And the same we see for Himalaya as well, with their listing and dual listing here in the US. I mean, it's a great company focusing on but they have the LNG propulsion. So there are the greenest ships out there, but they also have an economic factor to it. So I think there's definitely capital available as long as there is a feasible economical reason for it as well. Investors are not there just to sort of pour capital on any green decision if there isn't anything in it for them as well.
It's a great place to invest. I believe that there is significant differentiation of companies and strategies out there. So you have to be careful when you think about that. But absolutely, there's some great dynamics in terms of what's happening in many companies out there. It depends by sector, of course.
Yeah, no, I definitely agree, and I think it's been a good place for investors to get returns as well over the last couple of years. And Clarksons, sort of, our view is particularly really fond of tankers and bulkers. Tankers, we're already seeing that they've performed quite well so far this year, which stocks earning sort of 40-50%. It's been a great place to be in LPG, over 70% so far this year for the peer group. So I think if for investors to get sort of significant returns in something which is very relevant today, being energy security, which we touched upon. So I think it's a good place to get returns. So I definitely think it's a good place to start investing and invest as early as possible.
Absolutely. I think there's certain segments that are probably more attractive than others, but also keep in mind you can invest across the capital structure as well. So whether it's on the equity, preferred, or bond side, I think there are many ways that investors are definitely playing the cycle right now. But given the importance of global transportation and shipping is going to be a more important part of the overall decarbonization story. So this is absolutely a sector people need to be invested in.
Mike, are you an investor? If so, what sector and how would you do it?
Well, I'm an investor right now. I think the inflation story, I think, is a huge factor here. You can't replace these ships at levels that look anything like you could replace them, even a few years ago. And so, hard assets tend to do well in an inflationary environment, especially if they're employed. So maybe not commercial real estate, but certainly shipping, I think, is a good place to be.
I would echo what everyone else has said. Certainly, it's a good time to invest, and it's a good time to invest in many different strategies. We're investing both in secondhand ships. Like I said, I think it's a good time for it, but also in the new builds with what Mike said. With a bit more of that industrial approach with the long-term charters.
Sure. Well, I want to thank all my panelists today. It's been a terrific and insightful panel. Thank you for being here. Nicholas, thank you for putting on a wonderful event every year. You always draw a great crowd. Thank you for having us.